Jeremy Forrest with Premier Pro Washington Seal, back again with one last video on investing. Just kind of a recap, the top 10 things that I would like to discuss as we conclude this. Again, I'm not a financial advisor. I have no financial advice other than self-taught 20 years of reading books and investing and trial and error myself. And again, this is what has worked very, very well for me. And I hope that even if it helps just one person, that it's worth it. So I want to take the top 10 things that I want to leave you with, starting with the first one. Before you invest in any way, make sure you have 3 months of bills of expenses saved up for bills. You don't want to buy a stock and then times get really hard and maybe you've lost 30% since you bought it and you've run across a hard time and now you need money, and so you have to sell your stock before it had a chance to make you any money. So have 3 months of expenses saved up before you invest. Number two, once you get your bills saved up, strongly consider opening up a Roth IRA if you don't have one already. A very powerful tool for most Americans that are eligible for it. Essentially, it's a way for you to stash money without it being taxed. So you get taxed when you get paid, but if you put this money, your after-tax dollars, into a Roth IRA, it can grow tax-free up until you're 59 and a half. There are some stipulations that allow you to get it out earlier than that, but ideally you want it to grow as long as possible. At 59 and a half, you can take this money out without being taxed. So that is a very, 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 very powerful thing. So make sure you're taking advantage of that. For individuals in 2022, each individual can invest up to $6,000 a month. So that's $6,000 a year, or roughly $500 a month. So make sure we're taking advantage of the Roth IRA. Be open-minded to index funds. Yes, I love individual stocks, but as I've said before in other posts, other videos, that 88% of people cannot beat the market long term. And when I say long term, I'm talking about 10 years or more. Anyone can beat the market in a given year or two, or maybe even 3 years in a row. But to do it consistently, 10, 15, 20 years, it's extremely hard. And, as I said, 12% of people, of money managers, are so-called experts, can't even beat the market. So be open-minded. Index funds, they have a very, very low cost to run them. They just mirror the market. You're not relying on a mutual fund manager to pick stocks and hope that they can outperform it. This is in your own hands, very low cost, very diversified. It's an excellent way to invest for the majority of people. The illusion of mutual funds, I'm not saying mutual funds aren't bad. There are definitely some market-beating mutual funds, but again, you got about a 10% chance of finding those. What kills most mutual funds is the fee to run that mutual fund. So if you are going to be in mutual funds, make sure that you're paying attention to that mutual fund's fees, because that's what diminishes most people's returns and they don't even realize it. Number 5, long-term stock market gains. There's no doubt that the stock market is one of the greatest wealth creators of all time. It takes patience. It takes being disciplined. If you're patient and you're disciplined, then you will be rewarded with long-term market gains. And year over year, over the last 150 years of the history of the stock market, it has averaged a return of about 11%. So that's during the Great Depression. That's during the Vietnam War, the Cold War, the World War I, World War II, the 2008 crash, like all of the Great Depression, all of those really, really bad times. If for those who stayed patient, that understood this, they were rewarded with about 11% return. If you get 11% return, that means your money is doubling about every 6.5 years. You do that over a couple of decades and that becomes very, very powerful. Even with small sums of money, it can accumulate to large pots of money. So the biggest thing is you have to be patient, you have to be disciplined, and you have to understand the market. There will be times that it just flat out, it sucks. It's, you know, down 10, 15, 20%. If I'm being candid with you right now, I'm down about 20% overall on my portfolio, but I understand the power of being patient and disciplined and, you know, allowing the market to straighten itself out. And in the meantime, I'm buying shares at lower prices. So where people go wrong the most is they panic. As soon as the market starts shooting down, they panic and you know, they swear off the market. Be smart, be disciplined, be patient, and you will be rewarded really better than any other type of wealth creator. Number 7, understand that panic diminishes returns. And that just goes to what I'm saying earlier. It's the people who, you know, don't understand how to value a stock, They don't know what metrics to look for. They just go out and they buy a stock just because, you know, the family member or friend that they see as success recommended it. They've done no fundamental homework of their own, and, you know, they just go out and buy this stock, and, you know, the market starts going in a downward spiral. They panic and they sell, and again, they just swear off the market. They have no basic understanding that most likely if they would have just stayed in the market and rode out those hard times, they would have been just fine. Now, if you want to buy individual stocks, Warren Buffett has a wonderful quote that a lot of investors know and understand. It is far better to buy a wonderful company at a fair price than it is to buy a fair company at a wonderful price. So let me say that again. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Goes back to those metrics I was talking about before in the other video. Make sure you're buying industry-leading businesses. Businesses that have a strong moat, a strong competitive advantage. Businesses that you're confident are going to be there 10, 15, 20 years from now. If you do that, if you look for those type of companies and you're patient and you're disciplined and you know how to value that stock, as I showed you before in another video, if you practice all of those things and you wait for that company that you've been watching that has all the right metrics that you're looking for, it's just a tad bit higher than you'd like to pay, these are great times to stay patient when the market is tumbling, to go in and scoop those wonderful businesses at great prices. So always have this as your foundation. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. It doesn't mean just because you're eyeing a wonderful company such as Apple that you can just go out and buy it at any price. You still need to be patient and disciplined and know where your price point is to buy a company like Apple. I would love to own Apple. It is arguably the greatest business here in the United States, maybe in the world, that's being ran publicly. I would love to own it. It's just not at a price right now that I'm willing to pay for it, that I feel that I'm going to get the return on investment that I'm seeking. Number 9 is time in the market is far more important than time in the market. Again, time in the market is far more valuable than trying to time the market. If you're just sitting around, sitting on your hands, waiting for the market to crash even more, or that's never going to serve you well. I don't want to say never, but it's hardly going to serve you well. If you buy a company that you're very confident in, is a world-leading company, and you bought it at a great price and it's got strong fundamentals, you should not be panicking just because it's down 20%. In fact, you should be loading up even more if you're that confident. And as a bonus, if that company is paying dividends, then understand that when you're getting issued those dividends and you reinvest them, you're buying more shares of that stock at a lower price. And again, when the market does catch back up, you will have even better returns. Sometimes with the way that the market is ran now, algorithms are a real big thing. And so it could take maybe a company 2, 3, 4 years before the market realizes the price of that company. So take advantage of those times. The stock market is very emotional. It's not like a house that's worth $500,000 and the neighborhood gets some bad news and now all those $500,000 houses are now worth $300,000. That's not how any other asset class works. But in the stock market, it's very emotional. So you can have a wonderful company and everyone is panicking, and these great companies start selling at a far less price than their actual value. You won't see that in the housing market like you will in the stock market. So be patient, take advantage of those times. And then last, but certainly not least, understand the power of dividends. Dividends are a wealth creator. They are a game changer, especially if you're reinvesting them. Even a 2% yield on a stock now that's growing, that dividend's growing 20% a year, that can provide you a very nice income later on down the road if, again, you stay patient, you stay disciplined, you allow time to be on your side, and allow those dividends to keep buying more stock, and then those dividends buy more dividends, and it just becomes a snowball effect that can have a really, really positive impact on your net worth. Remember, cash flow is far more important than your net worth. So don't discount dividends. A lot of individuals, they look at dividends as like that's an old, stodgy business. Like, look at Walgreens. As I said before, Walgreens isn't going to double in price. They've pretty much already saturated all the markets that they're interested in entering. So the way that they reward investors, instead of growing and expanding, they reward investors through stock buybacks and dividends. And if you know this and understand this, this can generate a lot of money for you. Little bit of money can turn into a lot of money. So I hope this helps. This is my final video on investing. Again, it's worked for me very, very well. I'm very fortunate that I had someone 25 years ago come into my life that saw something in me that got me interested in investing. And I'm just trying to pass on a little bit of knowledge that I've attained over the last 25 years to other folks so that it can hopefully help them as well. Thank you.